If you're paying a ton of money in taxes every year, you're not bad with money. You just haven't learned how to exploit the tax loopholes that the IRS has already given you. So today I'm going to pull back the curtain and share the secrets and show you 17 ways that you can make $1 million completely tax free. Number one is the Roth IRA. In case you aren't familiar, a Roth IRA is a type of retirement investing account. You pay taxes before you put the money in, and then the money grows tax free forever. Roth IRAs are subject to annual contribution limits. Currently, that's $7,500 per year. And if you're over the age of 50, you actually get an additional $1,000 catch up contribution. So it'd be $8,500 for you if you fall into that category. What's nice about Roth IRAs is that because they're an individual account, you can actually open a Roth IRA for you as well as for your spouse, even if only one of you is working. The only rule here is that you have to have earned income that's equal to or greater than the amount you contribute to those Roth IRA accounts. So, simple example, let's say you're married, you're the sole provider for your family. You can open a Roth IRA for you and contribute $7,500 per year. And then you can also contribute $7,500 per year for your spouse as long as your earned income is at least $15,000 in that tax year. Now, I mentioned that Roth IRAs get taxed at the beginning. So, how is this a tax free strategy? Well, any money that grows within that account is going to be tax free for life as long as you follow the rules of the Roth IRA of when you withdraw the money. The simplest rule there is you have to be at least 59 and a half years old, and then you can withdraw your earnings from the account. So let's suppose that you're contributing $15,000 a year to a Roth IRA that's split half to you and half to your spouse. How long does it take for you to get to $1 million? And how long does it take for you to get to $1 million of tax free money? Well, if you contribute that $15,000 amount every single year, you invest the money within the account, and it grows at a 10% rate of return, it will take you 20 years and 6 months to build up a balance of $1 million within that account. Now, that's both contributions and the growth within the account. I already mentioned the contributions were taxed, so that's not really tax free. If we're just looking at the earnings or the growth within the account, it will take you 23 years and 4 months where your total earnings within that Roth IRA will be $1 million. And you hit the $1 million mark for making $1 million of tax free money. Something important to note here with Roth IRAs is that there are income restrictions. If your income is too high, you're no longer eligible to contribute to a Roth IRA. These income limits are based on your tax filing status, whether you're a single filer, head of household, married filing jointly, etc. So you'll want to go look up the income limits for your situation. If you are above the income limit where you're no longer eligible for a Roth IRA, there is a workaround called the backdoor Roth IRA. You've probably heard of it before. How this strategy works is that you make a non deductible contribution to an IRA, sometimes called a traditional IRA or a non deductible IRA in this case, and then you perform a conversion. So you actually take that money in your non deductible IRA and you transfer it over into a Roth IRA. That's the basic strategy behind the backdoor Roth IRA. It's for high income earners so that you can get around that income limit that the Roth IRA traditionally has. Maybe you're a little bit impatient like me, and waiting 20 years to get $1 million of tax free money in a Roth IRA sounds kind of slow to you. So let's see if we can speed things up with a Roth 401k. The nice thing about a Roth 401k is that the annual contribution limit is higher. So that's $24,500 per year in the Roth 401k compared to $7,500 per year in the Roth IRA. Roth 401ks are typically set up through your employer. However, if you're self employed, you can set this up for yourself in something called a solo 401k or other options depending on how your business is structured. How long will it take you to get to $1 million in tax free money with a Roth 401k making contributions as an employee? If you're contributing the maximum of $24,500 per year, that amount is going to get taxed when you put the money into the account, and then it's going to grow tax free within your Roth 401k. It takes 16 years and 3 months to get to $1 million balance in your Roth 401k, assuming your investments are growing at 10%. Now, the actual growth within the account, it takes 19 years and 8 months to get to that mark where you have $1 million of tax free growth. One of the nice things about Roth 401ks is that, yes, they have the higher contribution limits. They have a very healthy catch up contribution for people that are over the age of 50. And they don't have the same income limit restrictions that you run into with a Roth IRA. So if you're not eligible for a Roth IRA, you don't want to go down the route of a backdoor Roth IRA, then the Roth 401k is actually a really good option for you. And once you leave that employer, you can always roll your Roth 401k directly into a Roth IRA so that you have full control of the money. By the way, if you're enjoying this video so far, go ahead and hit subscribe. I release a new video like this every single Monday, and there's tons of other videos on my channel that you can go check out as well. All right, what if you're a high income earner and you're really impatient here? Then you're going to love strategy number 3, which is the mega backdoor Roth 401k. How does this work? Well, I mentioned in idea number 2 that as an employee, you can contribute $24,500 per year to that Roth 401k account. That's actually not the full contribution limit of a Roth 401k. The full contribution limit as of 2026 is $72,000. So, how does this work exactly? Well, in a 401k, you have both employee and employer contributions. $24,500 is that employee contribution. Then you might also have some employer contributions where you get a match from your company. Usually people stop there, but some 401k plans allow you to make what's called an after tax contribution to your Roth 401k. Once you make that after tax contribution, you'll want to request something called an in service Roth conversion. And this basically takes that after tax amount that you contribute and it rolls it directly into your Roth account. Now it's following the same rules and tax advantages of your normal Roth funds within your Roth 401k. The nice thing about this is by employing this strategy, and it's not available to everyone, but if it is available to you, you get to contribute $72,000 per year to that 401k plan. And this is drastically going to reduce the amount of time that it takes for you to get to $1 million in tax free growth. So, how long does it take? It will take 8 years and 7 months to hit that $1 million mark within the account. And then the earnings, that takes 13 years to generate a total of $1 million in tax free earnings. Strategy number 4 is the health savings account, or HSA. An HSA is a type of savings account that you can use for medical expenses, but it can also double as a retirement investing account, and I'll walk you through what that looks like. Big caveat on the HSA, you can only contribute to an HSA if you have a high deductible health plan. So if you have a low deductible plan, like a PPO plan or something else, you are not eligible for an HSA. You have to have the high deductible plan. Assuming you have a high deductible health plan, the HSA is also subject to annual contribution limits. The individual contribution limit is $4,400, but if you have a family plan, then that family contribution limit is going to be $8,750. A simple example would be if you and your spouse are both on a high deductible health plan, then you'd have that family contribution limit of $8,750. One thing that's really cool about health savings accounts is they have what's called a triple tax advantage. And how this works is that when you put money into the account, it actually goes into the account tax free. So any dollar amount that you contribute to your HSA is going to be an adjustment to your income on that year's tax return. It's effectively going to lower your taxable income dollar for dollar. That's the first advantage. The second advantage is that it grows tax-free within the account. So you can buy and sell and trade within the account, no taxes. That's the same as the Roth IRA that we talked about previously. And then the third tax advantage is you can actually pull money out of the account tax-free as well, as long as it's for medical expenses. And that's a big caveat there. It has to be for medical expenses. Thankfully, that's pretty inclusive for things like dentist visits, doctor visits, prescriptions, etc. If you pull money out of an HSA for non medical expenses, you're going to face a 20% penalty and taxes. So you really don't want to do that. The rules of the HSA actually change when you turn age 65. Once you're 65, you can pull money out of an HSA for non medical expenses. The only difference here is that if it's for a non medical expense, it's going to be taxed on the withdrawal. So it's not truly tax free unless it's for the medical expenses. So that begs the question, is it possible to reach that $1 million mark of tax free money using an HSA? And the answer is yes. If you're maxing out that contribution of $8,750 per year, it will take you 25 years and 6 months to reach the $1 million mark. The nice thing here is that we can actually count the contributions as well as the growth within the account in that tax free number because the contributions were tax free. Another small caveat on HSAs. If you have an HSA plan through your employer, make sure that you are setting up your HSA contributions as paycheck deferrals. And the reason why you have to do this is because when you set up your HSA contributions as paycheck deferrals, you actually avoid another type of tax, which is your Social Security and Medicare tax, and that's 7.65%. So do yourself a favor, set up your contributions as paycheck deferrals. You'll avoid federal income tax and you'll also avoid those Social Security and Medicare taxes that are sometimes known as FICA taxes or payroll taxes as well. Being strategic with your investments is literally a $1 million opportunity. And the earlier you get started, the more you can take advantage of these cool tax loopholes. So, if you're interested in not just hearing a cool strategy, but actually implementing it and making a real difference for your bottom line, use the link in the description below this video, schedule a free consultation with me, and I'm happy to help you out. If you're like me, at this point, the wheels are probably turning and you're thinking, okay, these individual strategies are great, but what would happen if I actually combine multiple of these strategies together? That's what strategy number 5 is. How long would it take us to get to $1 million of tax free money if we were to use a Roth IRA, an HSA, and a mega backdoor 401k? Well, here's the nice thing, you can actually do that. It's totally possible. You can combine each of these, and you'd be contributing $15,000 to two Roth IRAs, one for you, one for your spouse, $72,000 to your mega backdoor Roth 401k, and then $8,750 to your HSA. That gives you an annual contribution of $95,750. I know what you're thinking. That probably sounds out of reach and impossible, but it's actually not if you break it down. If you're a high earner, maybe you're making $300,000 a year, you could probably live off of $200,000 a year and actually use this strategy. So it's pretty attainable. Now, if you want to calculate the tax free growth within those accounts, it'll take you 11 years and 4 months to get there. So you're basically cutting your timeline in half of how long it takes to get to $1 million of tax free money. If you're a high earner, might be worth considering and seeing if you can make it happen. And of course, even if you don't get all the way there, any improvement is still good improvement. Strategy number 6 is a self directed IRA. Now, you can actually set up these accounts as Roth IRAs or traditional IRAs. A self directed IRA is a special type of retirement investing account that allows you to invest in alternative assets like real estate or businesses. You can't find these accounts at your typical brokerage like Vanguard or Charles Schwab or Fidelity. You have to go to a specialty brokerage that allows you to set up this account. Here's the nice thing, if you use a self directed IRA, you can take your money from a Roth IRA, a Roth 401k, a traditional IRA, a traditional 401k, transfer that money into a self directed IRA. And now you've unlocked a way for you to invest in real estate, in small businesses, in a way that you're going to have the same tax advantages of that traditional or Roth IRA, but you have much more control over where the money's going. You're not limited to stocks and bonds. This is an awesome strategy if you're trying to get to $1 million in tax free money because you could take a chunk, go buy real estate, Now, all of the rent that you're collecting is going to be in a tax free self directed IRA if you choose a Roth self directed IRA. Now, of course, there's some caveats here with this strategy. The first one is the self directed IRA usually works the best if you already have a pretty big chunk of money that you can use to fund the account because it's going to take more capital to buy something like real estate or a small business. The second caveat is that there's a lot more in terms of compliance around these accounts. And if you make a mistake, you could actually have that entire amount within your account now be considered taxable. So, this isn't a strategy that I would try and just DIY on your own. You definitely want a professional in your corner to make sure you're crossing your T's and dotting your I's to make it happen. But totally a legitimate and awesome way to make $1 million in tax free money. If you want to know more about how to use a self directed IRA, I have an entire 45-minute video just on that topic. I'll include the link in the description below. So if you want to do a deep dive, you can go check it out. I also interviewed a millionaire real estate investor previously on the podcast, and he did this strategy in his own life. So if you want to hear his firsthand experience, I'll include the link to that video as well in the description below, and you can go watch my interview with him. Strategy number 7 is a real estate one, and it's a live in flip. So, what is this exactly? You buy an old junker house that needs to be renovated, you live in it, you improve the house, and then you end up selling it for more money later on. How does this help you get to $1 million in tax free income? The tax code actually allows for a $250,000 capital gains exclusion when you sell your primary residence, and there's a few rules around this. The first rule is that you have to own the home for at least 2 years and you have to live in the home for at least 2 years out of the last 5 years. So this can't be an investment property. It needs to at least be your primary residence for a period of 2 years. How would you execute on this strategy? I'll give you a simple example. Let's say you go buy a house for $250,000. It's kind of a junker. You spend $100,000 and you renovate the house. Now your adjusted basis in that home is $350,000, basically the total amount of money that you spent to get the house to its current state. Let's suppose for a minute that the home appreciates in value. If it goes up $500,000 to $850,000 and you sell the home, you can claim that capital gains tax exclusion. So your total gain on the home is $500,000. If you're single, you get a $250,000 exclusion that's taxed at 0%, which is pretty flippin' amazing. And if you're married, this actually doubles. So you get a $500,000 tax exclusion taxed at 0% just for selling a house for more than what you bought it for. This is honestly one of the most amazing strategies out there. Obviously, there's some big caveats. You have to be willing to live in an old home while you're renovating it. You probably have to have some construction knowledge as well. But if you're someone that maybe wants to go a somewhat non traditional path, this is an absolute home run if you're looking to build some wealth. Just make sure you do your due diligence. If you want to know more about what it's like to actually go through a live and flip, I interviewed a real estate millionaire on my podcast previously, and he shared his firsthand experience of how he and his wife did it. I'll include the link to that video in the description below, so go check it out if you want to learn more about this. Strategy number 8 is an extension of that $500,000 capital gains exclusion for selling a primary residence. With this one, instead of doing a live and flip, you can actually just build a home from scratch. So you go buy a plot of land, you build the home, you basically put some sweat equity into it, and then you can later sell the home. You just have to follow those same rules of owning the home for at least 2 years and living in the home for at least 2 years. So your clock would basically start from the date that you finish the house, you're now living in the house. If you wanted to get to $1 million in tax-free money with this strategy, you're probably looking at least a 6-year timeline, maybe a year to purchase the land, build a home. You have to live in it for 2 years. That's a total of 3 years for the first home. Now you sell it, you have a $500,000 capital gain that's taxed at 0%. And then you go do the exact same thing with a second home. Hey, if you want to get to $1 million in tax free money, 6 years is a pretty quick way to do it. I actually have a friend that used this exact strategy, and I got to talk to him every week about how it's going. So it was really cool to see this strategy unfold in real life. The $500,000 capital gains tax exclusion was limited to a primary residence that you've lived in for at least 2 years. Well, is there a way to do something similar with an investment property where you don't have to live in the home? The answer is yes. And that's going to be strategy number nine, a cash out refinance. Let's suppose, for an example, that you purchase an investment property. Maybe you've owned it for a long time. You've completely paid off the mortgage. That home has appreciated to a total market value of $1,250,000. So you have this asset on your balance sheet that's worth $1.25 million, but the problem is that's totally illiquid. If you sell the house, now you're going to be facing a ton of capital gains tax. Or if you continue renting out the house, you're just slowly collecting rent income, but you're not really accessing this underlying capital unless you use a cash out refinance. How does this work? You could actually go and set up a new mortgage loan on the home. Since you already own the home outright, all that money basically comes to you. Now, yes, of course, now you're going to have a mortgage payment and you're paying interest on that, but it allows you to access up to 80% of the home's market value in cash. So for a home that's worth $1,250,000, you now have access to $1 million of capital tax free because it's considered a loan that you can go use to invest in other property or whatever else you might desire. Now, of course, this strategy comes with some huge caveats because you already have to have a pretty big asset to do it, but it is 100% a legitimate way that you could access $1 million in tax free money. Do you have to have a fully paid off house to do this? The answer is no. You could have a house that still has a mortgage, but it's appreciated in value. You take out a new mortgage for a higher balance. You use that to pay off the old mortgage, and then you get to pocket the difference as cash that you could invest in another property as well. So you don't have to have a fully paid off house in order to do this. It's just the more untapped equity you have in the house, the more capital you're going to be able to access in that cash out refinance. Strategy number 10 is a 1031 exchange. This is a way to defer capital gains taxes when you're buying and selling real estate. How does it work? Well, let's say you own an investment property that's worth $500,000 and you decide to sell that property, which would normally incur some capital gains taxes since it wasn't your primary residence. Any capital gain would be taxed accordingly. However, there is something called a 1031 exchange that you can leverage here. There's some strict rules you have to follow, though. The first rule is that within 45 days of selling that home, you must identify a replacement property. And this is a super strict rule by the IRS. It has to be within 45 days that you identify the next property that you're going to replace it with. Now, you can list up to 3 properties just in case one of them falls through or goes to another buyer or something like that, but this is a pretty strict rule. The next rule is that within 180 days of selling that first home, you must invest the full amount into a new property and have that property close within that 180-day window. So you've got the 45-day window to identify the property you're going to purchase, and then you have the 180-day window to actually purchase and close on the new property. What does this allow you to do? It allows you to take any proceeds that you have from the sale of that first home and invest them into a new piece of real estate. And in performing that transaction, that amount of money is now exempt from capital gains taxes. So it's a really cool strategy that you can roll your money over and you can defer capital gains later on down the road. Now, here's what's actually cool is if you want to leave this property as an inheritance, maybe to your kids, when you die and you pass on that property to your kids, that final real estate investment that you have receives a step up in basis to the current market value, which means that you have essentially given your kids a $1 million tax free inheritance. So, this is a really cool strategy. If you're thinking about that legacy planning and you want to leave some sort of tax free asset to your kids, you might want to consider using a 1031 exchange along the way to invest in real estate. Strategy number 11 is a qualified opportunity zone investment. What is a qualified opportunity zone? Kind of a mouthful. Well, the government has designated specific geographic areas of the country as opportunity zones. And these are basically areas that the government is trying to incentivize investors to substantially improve the community. You can use this to your advantage to make an investment that's going to give you some really cool tax free advantages and help you hit that $1 million of tax free money. There are some very specific rules around this. So let's suppose, as an example, you purchase a piece of real estate in a qualified opportunity zone for $500,000. One of the main things that you need to do in order to qualify for tax free money is that you have to substantially improve that property at least to the amount of your basis in the property. So, how does this work exactly? Well, if you purchase the property for $500,000, you would want to add an additional $500,000 of improvements to the property. So now your total investment, you're looking at $1 million. The next requirement you need to meet is that you have to hold the investment for at least 10 years. So it's going to take you 10 years to get to $1 million of tax free money with this strategy. But let's say that over the course of those 10 years, your investment appreciates in value from $1 million to $2 million. You can now sell your investment, and your $1 million capital gain is going to be free from capital gains tax and net investment income tax, all because you chose to invest in a qualified opportunity zone and followed the rules that you needed to. The IRS is literally building these loopholes so that anyone can make tax free money. And I know what you're going to say. I know what you're thinking. Well, I don't have $500,000 to go buy a property. The good news is you don't need to, because there are things called real estate syndications where you can pool your money with other investors' money and go purchase a property that's in a qualified opportunity zone. I actually have a friend right now that is a general partner of a real estate syndication. He is raising capital for an exact deal like this as we speak, where he's pulling in limited partners. They're contributing the money, they're not doing any of the work, and he's helping use their assets to purchase this property in a qualified opportunity zone where they can get tax free earnings. So, this is a really cool strategy. If you like real estate, it's definitely one you want to consider. Strategy number 12 is the standard deduction. And I know this one's a little bit gimmicky, but hear me out. I'm actually going to use it in one of the upcoming strategies for a really cool combination effect. Every year when you file your taxes, you have something called the standard deduction. And this is basically a 0% tax bracket. It's a certain amount of your income that you can automatically deduct no matter what your personal expenses are. So you don't need to own a home to use this. You literally just need to file taxes in America. Currently, the standard deduction rate is $32,200 for a married couple filing jointly. That means that every year, the first $32,000 of your income is taxed at 0%. And honestly, that's pretty cool. So, is it possible to become a millionaire off of this? The answer is yes. It's going to take you forever. It's going to take you 31 years and a month to get there, but most people work for 30 years anyways. And so, if you have a regular career, you're actually already earning $1 million in tax free money. You probably just didn't know it. Now, that's kind of the default. Obviously, you want to get there a lot faster than 30 years. So I'm going to share a strategy here in a second that we're going to use that standard deduction and multiply the effect. Strategy number 13 is tax gain harvesting. What does this mean? Well, what's interesting is investments or passive income are taxed differently than your active income. So if you go work at a job or you're earning money in a business, you're subject to those progressive tax rates that start at 10%, go up to 12, 22, 24, and so on, all the way up to 30%. If you have investments like, for example, owning stocks, index funds, mutual funds, etc., those investments are usually taxed as capital gains. And the capital gains tax brackets are significantly lower. It's either 0%, 15%, or they max out at 20%. The nice thing is that the 0% capital gains tax bracket is actually pretty forgiving. And you can use this as an early retirement strategy to pull money out of your accounts in a tax free way. So, most of the strategies that we've been talking about up to this point are more in the accumulation phase, so to speak. But what if you're someone that, maybe you're 50 years old, you have $1 million of stock value appreciation in a taxable investment account, and you're thinking, man, there's no way to access this money without paying taxes. The answer is yes, you can totally do it through the 0% capital gains tax bracket. How does this strategy work? Well, each year for married couples filing jointly, you can have $98,900 of capital gains that are taxed at 0%. So, just as an example, let's say you are in early retirement, and in this situation, you withdraw, call it $200,000 from your taxable investment account. As long as the gain on that amount that you withdrew is less than $98,900, that's going to be taxed at 0%, which is pretty awesome. And that's why it's called tax gain harvesting, because you're realizing the gains on your investments, but you're not paying any taxes. You're basically experiencing a free step up in the cost basis for your investments. And if you want to, you can take the money, you can turn around again and reinvest it within the market. If you were to pull out that maximum amount, $98,900, it would take you 10 years and 2 months to withdraw a total of $1 million in tax free money. One thing that's really important to note with these capital gains tax brackets is that the tax bracket isn't just calculated on your capital gains, it's actually calculated based on your taxable income. So that limit is including both your actively earned income and your passively earned income. So if you work a really high earning job and then you're also selling your investments on the side, even if your total capital gains are less than that $98,900, your active income is going to push you out of that 0% bracket, which is why this is more of an early retirement strategy where your active income is going to be pretty low. Let's take things a step further in strategy number 14. And before I share how this strategy works, I actually need to give you a little bit of background on how taxes work in America. When you earn money, let's say you earn $100,000. The first thing that comes off when you're calculating your taxes is something called adjustments to your gross income. And these adjustments are things like your retirement account contributions. So if you contribute $5,000 to a traditional 401k, that's lowering your income from $100,000 to $95,000. So first you have those adjustments. The next thing you have is deductions. So for most people, this is going to be the standard deduction. That's also lowering the amount of money. And now you're landing at something called taxable income. So taxable income is the amount of your money that gets taxed after you've calculated adjustments and deductions. Why does this matter? Well, because there's a way that you can combine the standard deduction with that 0% capital gains bracket to actually be making quite a bit of money each year and still pay $0 in taxes. How does this work? Let's suppose that you have $32,200 of active income. So maybe you're working part time on the side, something that you enjoy doing. Well, if you have $32,200 of active income, that's going to be completely erased by the standard deduction of $32,200. So we're still at zero here. And then let's suppose that you sell some investments and you have a $98,900 capital gain. All of that is going to be taxed at the 0% bracket for capital gains. So now you're effectively making $131,100 per year and paying $0 in taxes. So if you wanted to make $1 million in tax-free money, you could use this strategy for 7 years and 8 months, and you'd get there just by combining the standard deduction with the 0% capital gains bracket. Here's where things get really crazy is that we haven't added in those adjustments to income. So let's take things a step further here. And what would happen if you contributed to a traditional 401k and an HSA? Well, now you have an additional adjustment of $24,500 that you're contributing to that traditional 401k. That's reducing your taxable income, by $24,500. You're also contributing to your HSA, and that is also reducing your taxable income by $8,750. So if you're leveraging a traditional 401k, an HSA, and the standard deduction, you could actually be making $65,450 per year, and none of that money's getting taxed. Now we add that to the capital gains that you're making of $98,900. And lo and behold, it is 100% possible and entirely legal to be making $164,350 per year without paying a penny in taxes. That's amazing, and it's all because you know how to use the loopholes. Strategy number 15 is an asset class we haven't looked at yet. Is there a way to make stable income without paying any taxes? The answer is yes, and it has to do with a certain type of bond. There are bonds called municipal bonds that allow you to earn tax free income. Municipal bonds are bonds issued by state and local governments, and they have a nice perk of being federal income tax free. Depending on the type of bond, these could actually be state income tax free as well, which is pretty cool. So, how could you get to $1 million of tax free money by using municipal bonds? Well, let's just suppose, as a simple example, you have a $1 million bond portfolio, and those bonds are paying you 4% in interest per year. You're collecting $40,000 per year in tax free income from that bond portfolio. And if you're collecting $40,000 a year, it would take you 25 years, but you would get to $1 million of tax free income, which is pretty sweet. Strategy number 16 is a government incentive to invest in small businesses. It's called Section 1202, Qualified Small Business Stock. How does this work exactly? Well, you can invest in small businesses, and you have to fulfill some requirements here. So it must be a C corporation, and it also has to be a qualified business. There are certain types of businesses that don't qualify. So you definitely have to do your homework and make sure you're investing in the right type of business. And you have to hold that business stock for at least 5 years. There's a few other requirements as well that you'll want to make sure you're complying with. But if you meet the requirements of owning qualified small business stock for at least 5 years, when you sell that stock, up to $15 million can be excluded from capital gains and net investment income tax. So, just as a simple example, if you invested $500,000 into small business stock and held it for 5 years, that business stock you later sold for $1.5 million, you have a $1 million capital gain that you're paying 0% tax on. That's pretty freaking sweet. Strategy number 17 is my personal favorite because it involves moving to a tropical island. And there's a certain tropical island where if you move there, you can actually pay 0% tax on interest, dividends, and capital gains through an individual resident investor program. Now, what's really cool here is, let's say you have a large taxable investment account. Maybe you have savings accounts as well that are paying you interest. If you move to Puerto Rico, there is a special incentive where you pay 0% tax on those investments. Now, there's definitely some big caveats here. The main one is that you must be a resident for at least 183 days out of the year. So you do have to have a primary residence in Puerto Rico. You can't cheat your way around this. You also have to purchase a primary residence in Puerto Rico. So you have to own property there. You have to live there for half of the year. And another huge caveat is you have to make an annual donation of $10,000 to a Puerto Rican charity. So this is definitely not the strategy for the everyday person, but I think it's pretty cool that you can literally make $1 million in tax-free money by moving to a tropical island. If you're someone that's a high net worth individual and you're like, yeah, full send, I want to do that, just know that this actually goes away at the end of 2026. So you have to apply by December 31st of 2026. After that, they're changing the rules to a 4% tax. So, hey, you got a few months to go make that happen and still lock in your 0% capital gains tax and retire to Puerto Rico. That sounds pretty cool. It took a pretty big chunk of my Saturday to make this video, so if you enjoyed it or you learned something new, the number one thing you can do to support me is hit subscribe, and I'll catch you in the next one.